Ever feel like the so-called experts are steering you straight into the rocks instead of the riches? Stay tuned because today we're flipping the script on conventional stock market wisdom. Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where few arrive in the stock market without getting overwhelmed. I am Francisco and I'm an expert in finding stocks that can top the S&P 500. See, I've spent years studying the markets, much like a hound dog on the trail of a fresh scent. And in my experience, a lot of what is celebrated as solid, conventional financial advice ends up dragging you down instead of lifting you up. Over time, these so-called safe bets often leave many folks underperforming, even against the well-known S&P 500. That's why I'm here, to shine a light on how the beaten path might be holding you back and to uncover a few surprising yet time-tested ways to break away from the pack. Let's dig in. Conventional financial advice often sounds like this: buy a variety of popular index funds or just diversify across the board, and you'll be fine. It's the advice you hear from mainstream media, typical advisors, or even well-meaning friends. They might say, follow what everyone else does, and you won't get burned. On the surface, it sounds safe, like following the dotted line on a treasure map. But what dotted line can lead to average returns at best and missed opportunities at worst. If you've got a busy life, maybe working full-time, juggling family, or just lacking the hours to sit in front of stock tickers all day, conventional advice feels comforting. Yet, what if that comfort comes with a cost? Sometimes, the crowd's path leaves you locked into the same cycle as everyone else, netting a return that's okay, but far from beating the S&P 500. So, what's on the unbeaten path? Think of it as forging your own trail through the woods. You research companies more closely, evaluate future trends, and don't just go with the next hot sector because the media says so. Instead, you focus on a company's fundamentals, like earnings, leadership, competition, and decide if the price today is lower than the future value it's likely to generate. This approach isn't always flashy, and it won't score you short-term bragging rights, but it can place you on a different level entirely. A place where you're not just riding the market's waves, but setting your own course to outpace the broader indices. Unconventional financial advice is anything that strays from the usual script. Instead of set it and forget it or just match the indexes, it encourages hand-picking shares in companies with strong competitive advantages, durable value, or overlooked growth potential. It might also mean adopting a contrarian mindset, buying a solid firm when the market is overly pessimistic, or holding on to a winner longer than others would. Essentially, unconventional advice steps off the trodden path of mainstream guidance to pursue strategies that rely on deeper research, patience, and the personal conviction of the investor. If you're frustrated by subpar returns or nervous about the idea of just trust the process, unconventional financial advice can give you clarity. It resolves the tension between feeling stuck and wanting to do better than the typical cover your eyes and hope for the best approach. If your day job doesn't allow you to babysit your portfolio and you're tired of missing out on real opportunities, a tailored, less conventional route helps you break free from the herd. It's about resolving the pain of mediocrity and replacing it with the sense of control and higher potential reward. Unconventional advice can help you spot hidden gems, timing mismatches, or undervalued companies that others overlook. By digging deeper, you're not at the mercy of hype cycles or the everyone else is doing it mentality. Instead, you become the decision maker, focusing on fundamentals like return on equity, reliable leadership, or stable business models, in the long run, this can provide that extra edge, beating the S&P 500, weathering downturns with greater confidence, and feeling less anxiety about your portfolio's direction. You take the wheel and chart a course toward greater returns, rather than letting the crowd steer you to average results. Dividend investing is sometimes seen as standard fare, but here's the twist. Target companies with a dividend payout that increases steadily year after year, then reinvest those dividends manually, choosing the best moment to buy more shares rather than letting an automated system do it. Let's say you're tracking a company with a habit of raising its dividends every year. Normally, folks assume you'll just auto-reinvest each quarter. That's well and good, but you could add an extra layer of strategy by waiting for a day when the price dips below its normal trading range. Maybe after a negative headline hits or quarterly earnings are misunderstood by the market. Then you manually deploy your accumulated dividends to buy extra shares at a discount. Feeling you have no control over your reinvestment strategy, just passively collecting dividends while the price or timing might not be optimal. The benefit is potentially increasing your returns over the long haul. Imagine picking up more shares when they're on sale. Your reinvested dividends can compound faster. Over time, it's like giving your portfolio a small booster shot at each opportunity. Yes, it takes a bit more effort than fully automated investing. But if you want a hands-on way to potentially outperform an index, this small tweak can add up, and it might not be something your neighbor or coworker is doing, which gives you a little advantage in the quest to outshine the S&P 500. When markets turn sour, everyone and their grandmother seems to panic. Shares tumble, news anchors speak of doom, and their friends can't stop talking about how everything's crashing. However, that meltdown can be a golden chance to buy fantastic companies on sale, particularly ones with strong balance sheets, robust profit margins, and a history of weathering tough times. This isn't about gambling on struggling penny stock. It's about picking proven winners that happen to be on clearance due to market fear. Why this helps? The pain for many is feeling helpless during market downturns, seeing their portfolio drop and wanting to run for the hills. But if you are prepared, you can turn fear into opportunity. Rather than running away, you move in carefully, picking up shares of rock-solid businesses at a fraction of their usual cost. Over the years, these discounted purchases often bounce back stronger once the economy recovers. And the benefit? Instead of your account taking a permanent hit, you could end up with a bigger stake in a good company at a lower price, setting yourself up for accelerated growth when the market eventually returns to form. This contrarian stance, where you step in during bad times, goes against conventional advice that often screams, "Stay safe, don't do anything." But historically, many great fortunes have been made by investors with the great courage to buy at a time when everyone else is selling. They harness the power of patience, capital, and a bit of market savvy. Most folks tell you to spread your money around all kinds of industries and never put too much in one basket. But here's an unconventional angle. Find that one unstoppable industry leader whose products or services dominate the market and put a bigger chunk of your portfolio there. Assuming, of course, you've done extensive research. Maybe it's a top dog in semiconductors, a powerhouse in consumer goods, or a leader in biotech with consistent breakthroughs. If the company's business model is robust, if management is visionary, and if consumer demand has nowhere to go but up, concentrating your investment might yield outsized returns. The pain it addresses is the frustration of diversification, where you hold so many stocks that even the winners don't significantly move the needle. You're spread so thin you might as well be an index fund, which won't outdo the S&P 500 by much, if at all. The benefit is that by placing bigger bets on your highest conviction idea, you can capture more dramatic growth. Of course, you need to stomach the risk if the market goes against you in the short term. But that's why thorough research is key. Knowing the business inside and out so you have the conviction to hold on when the market hits a rough patch. Is this the popular approach? Not usually, but many legendary investors made their mark by going big on a few great ideas instead of scattering their money across dozens of mediocre plays. Financial advisors, radio shows, and popular investing websites often push the same narrative. Keep your money in index funds, rebalance annually, and call it a day. Going against that grain can feel like you are deliberately ignoring professional wisdom. There's also the worry of feeling foolish if things go wrong. After all, if everyone else says follow conventional advice, who are you to say otherwise? Add in the pressure of a family or friends who believed in the mainstream approach, and it's daunting to break away. Rather than outright rejecting your advisor's recommendations, ask for data behind them. If you're told to just buy this index, request performance histories, risk analysis, and scenario testing. Then do the same with your own unconventional picks. Compare them side by side. By translating both approaches into cold, hard facts, you remove the emotional weight of advisors say so. You're simply making a data driven decision. If your advisor can't provide detailed analysis, or you just find their reasoning lacking, that's a strong signal you're not misguided in forging your own path. This data duel helps you approach your new strategy logically, not just emotionally, reducing the fear of stepping away from mainstream opinion. Many people hear unconventional and picture reckless bets, short squeezes, or penny stock gambles. They fear that going off the beaten path means ignoring basic principles like diversification or risk management. If you're earning a comfortable salary and supporting a family, you might not want to gamble away your savings. Following the safe route, like broad index funds or a mix of well known dividend payers, feels far less daunting than stepping into the unknown. After all, your financial stability is on the line. Carve out a test portfolio. It might be only 5 or 10% of your total investments, an amount small enough that it doesn't jeopardize your entire future. In that test portfolio, apply your unconventional strategy. Maybe you buy one or two overlooked companies that pass your analysis. Keep the bulk of your capital in your usual, more conservative picks. Over time, track the performance of your test segment separately. If it starts outpacing everyone else, delivering consistent gains above the S&P 500, it might give you the confidence to shift more funds into your unconventional picks. This approach turns bigger risks into small-scale experiments, letting you wade into the waters rather than diving headfirst. Between analyzing P ratios, debt levels, market trends, and reading up on future technology shifts, investing can feel like a giant puzzle. Throw in the possibility of unconventional strategies, and it might seem you need a PhD in finance just to pick a stock. You worry that you'll drown in conflicting data, expert opinions, and endless reading, leading to either inaction or panic decisions. Use a one-sheet method, summarize each potential stock on a single page. Include bullet points on revenue growth, profit margins, debt to equity, management highlights, and a brief note on market conditions. Also note your thesis statement. The one-sentence reason this company can outdo the S&P 500 over time. By forcing yourself to distill an entire company's story into one sheet, You simplify without losing sight of crucial facts. Whenever a new piece of data emerges, see if it's important enough to revise that one sheet. If not, ignore the noise. This streamlined method helps you maintain clarity, focus, and control, even in a world brimming with complex information. Everything's priced too high these days, or so the sentiment goes. You might see stories of how Apple or Amazon were great buys in the past, but now they're fully valued. Meanwhile, smaller companies that might have potential either look risky or have already run up in price. It feels like you're showing up to the buffet after all the best dishes are gone. Redefine deal. Instead of chasing low price to earnings ratios alone, look for a fair price on a high quality company with substantial growth potential ahead. Even if the PE isn't rock bottom, if the company's revenue could double in 5 years, today's price might actually be a bargain. Investigate less followed industries or sectors. Read local business journals or check patent filings for emerging technologies. There's often an overlooked stock or two that remains under the radar. By changing how you define a deal, you'll see opportunities in companies that still have plenty of room to run, even if they aren't cheap by conventional standards. Sometimes paying a fair price for a wonderful company beats snagging a cheap price on a mediocre business. Some stocks get so popular, maybe it's a big tech name or a hot new disruptor, that everyone piles in, driving the price sky high. Conventional chatter might say, it's a great company, just buy it. But ignoring the valuation could lead you to pay far more than it's worth. If the stock is trading at, say, a P ratio of 80 or 100, it has to keep posting stellar growth to justify the lofty price. Even a small earnings miss or growth showdown can cause a massive drop. So, while it might feel safe because everyone owns it, the actual risk is quietly mounting. The result? You end up with a portfolio that looks impressive on paper. But the second the market corrects or adjusts its expectations, your high flyers can become crashing down. Investors sometimes learn this lesson the hard way, seeing a 30% or 40% drop in a matter of days when a beloved stock's luster fades. Consider what I call the red tag bargain hunt. Even if you like a popular company, you decide on a maximum price you're willing to pay based on fundamental analysis, like the firm's projected growth rate, cash flow generation, or comparable industry valuations. You then wait until the stock trades at or below that price. If it never does, you walk away. If it does, you buy. This might mean you skip the initial hype wave, but you also drastically reduce your risk of owning an overinflated stock. The creative angle: set up fair value alerts. For each company on your watch list, do a quick discounted cash flow calculation or a simpler multiple based approach to guess a fair price. Put that in your brokerage alert system or a spreadsheet that pings you when the stock nears that target. The moment it dips into your fair value zone, you can do a final check. Maybe confirm the company's fundamentals haven't deteriorated, and then pull the trigger. The benefit is enormous peace of mind. You are not chasing the crowd, you are stalking quality companies and waiting for the right moment. This helps preserve capital and reduces the gut-wrenching volatility that comes from overpaying. Over time, that discipline can reward you with better returns because you're buying growth at a rational price, allowing more upside if the company continues to perform well and less risk if the market suddenly wakes up and corrects the stock valuation. A lot of folks can't resist the urge to take profits the moment a stock rises by, say, 20 or 30%. Conventional advice often warns you'll never go broke taking a profit. But here's the catch: if that stock was a true powerhouse, capable of doubling or tripling over several years, selling too soon can be costly. Suppose you bought a revolutionary tech firm and it soared. Selling right away might set you some short term gains, but you miss the far larger upside if the business keeps scaling. The consequences include stunting your potential returns and piling up unnecessary transaction costs. You also turn your focus into short term trading, constantly searching for the next quick pop. This can derail you from finding those few extraordinary companies that can truly beat the market over a long stretch. Adopt a staggered exit strategy. Instead of selling your entire position once you're up a certain percentage, lock in gains on a fraction, say 20 or 30% of your holdings, while letting the rest ride. This approach scratches the itch to capture some profit while still keeping a piece of the potential multi-year upside. As the company continues to grow, you reevaluate at regular intervals. If it's still strong fundamentally, you hold or even add more shares. If something changes drastically, like a leadership shakeup or flattening sales, you adjust accordingly. The creative twist: use growth milestones to guide partial sales. For example, if the company hits a major expansion milestone or launches a new product that dramatically increases market share, you might hold onto more shares. Conversely, if it fails to meet key objectives, you might offload a bit. This nuance helps you avoid purely emotional decisions. The benefit: you keep a seat at the table for big gains, even if you take some chips off to reward yourself or reduce risk. You're not slamming the door on a potential rocket stock. This balanced approach can also reduce regret. If the stock keeps climbing, you're still in it. If it tanks, you already locked in partial profits. Over time, the real winners in your portfolio can overshadow those losers, thereby increasing your chances of topping that elusive S&P 500 benchmark. Many people, often influenced by social media hype, jump into stock investing like it's a casino. They chase after hot picks, penny stocks, or meme stocks without understanding the underlying businesses. It's all about the quick thrill, the adrenaline of huge daily gains or losses. This approach isn't just conventional in the sense of everyone else is doing it. It's an exaggerated offshoot of conventional mania. The problem is, gambling on stocks means you're not truly investing. You're speculating on momentum, rumors, or short term catalysts. The consequence: big swings in your portfolio. You might get lucky a few times, but the house, aka the market, usually wins over time if you're playing without strategy. You can rack up margin debt, stress, and emotional whiplash. Worst of all, you learn little about genuine wealth building, which sets you back from ever consistently beating the S&P 500. Consider a business owner mindset. Every time you buy a share, imagine you're purchasing a small piece of that business. You wouldn't gamble on a local restaurant without checking its financial health, competition, or future prospects. Apply that same logic to your stock picks. Ask yourself, if I had to own this business privately for 10 years, would I still buy it? This shifts your perspective from short term price movements to long term value creation. To inject a creative spin, maintain a business dashboard. For each stock you own, track key performance metrics like total revenue, net profit, cash reserves, or new product lines, just as a store owner would track daily receipts and inventory. Update the dashboard quarterly, not daily. This helps you see real progress, not short term fluctuations. The benefit is that you avoid knee jerk trades and start focusing on the structural growth of companies. If the fundamentals look strong, Short-term dips become buying opportunities rather than panic signals. Over time, this approach fosters a more consistent trajectory toward market-beating returns, and you'll sleep better at night. You're no longer rolling dice but making informed, calculated decisions based on underlying health of each business. That, in the long run, is how you truly set yourself apart from the crowd. Mainstream advice sometimes says things like, at age 50, shift most of your money into bonds or super safe stocks, and so on. While there's a kernel of truth in adjusting your asset allocation over time, this blanket approach ignores individual goals, risk tolerances, and market realities. Just because you've hit a certain birthday doesn't mean your best opportunity to beat the market disappears. If you're 55 and plan to work another 15 years, that's still a decent time horizon. The consequence is missed returns. You might lock up your money in ultra conservative options prematurely, watching from the sidelines as market opportunities pass you by. Or you might assume you have to follow a standard glide path into low yield investments because everyone else your age does. That can erode the very advantage you spent years building: your knowledge, your high income, and your ability to save aggressively. Adopt a goal-based portfolio instead of an age-based one. Start by identifying your actual objectives. Do you want to retire in 10 years with a certain income level? Are you planning to help fund a child's college soon? Based on these timelines and goals, partition your portfolio. Part might be in steadier dividend-paying blue chips to generate income, but another chunk could still go into high-potential growth stocks if your horizon allows. Here's the creative twist: implement dynamic rebalancing triggers. Instead of automatically shifting your portfolio based on age, shift it based on milestones. For example, when you reach a certain net worth or your best growth stock hits a predetermined valuation, that's your cue to trim or adjust. Or if you complete major financial goals, like paying off a mortgage, you can free up more capital for higher risk, higher rewards plays. The benefit is that you tailor your strategy to your personal financial picture, not just a one-size-fits-all age bracket. This can open the door to outsized returns even later in your working life and prevent you from getting stuck in the conventional box that might not serve your unique needs. Ultimately, it means you keep the potential to beat the market alive, instead of shutting it down just because you hit a certain birthday. Here's a quick but eye-opening exercise you can do on your next lunch break. Pick one company, just one, that you've been curious about. It could be a mega cap tech firm, a mid-sized retailer, or a lesser known industrial supplier. Print out or open on your phone the latest annual report or a summary of its financials from a reputable site. Then go buy a cup of coffee or your favorite beverage and sit down for 30 minutes with just two things: your coffee and that financial summary. During that 30 minutes, ask yourself these questions and jot down quick notes. How does this company make money? What's its main product or service? Who are its customers' businesses, consumers, or both? How has its revenue and net income changed over the last 3 to 5 years? Does the company have a moat, something that keeps competitors from easily replicating its success? Finally, estimate what you personally think the company is worth. You don't need a fancy model, just an honest gut check. If you believe it's going to grow 10% annually for the next 5 years, does today's stock price reflect that, or does it seem overpriced? Once you do this, compare your impression with what mainstream analysts say. Is there a mismatch? If so, that could be either an opportunity, the market might be undervaluing the stock, or a warning sign, it might be trading way too high, hoping for unrealistic growth. Why is this step so powerful? Because it forces you to engage deeply with a single business in a short, digestible chunk of time. You're not scanning the entire S&P 500 or diving into complicated charts. You're simply having a coffee conversation with the fundamentals of one company. This can spark a deeper curiosity. You'll start noticing details like whether the company's CEO has a solid track record or if the firm is weighted down by too much debt. Those details often determine which stocks can truly beat the market over the long haul. If you love what you find, you can investigate further. If you hate what you see, you've potentially saved yourself from buying into a disappointment. Either way, you've taken a meaningful first step into the realm of unconventional, informed investing. This approach alone sets you apart from many casual investors who buy on hearsay. Keep repeating this coffee cup value check for different companies, and in a matter of months, you'll have a deeper knowledge base and a more confident perspective on which stocks might be hidden winners. Thank you for joining me on this deep dive into how conventional advice can hold you back and how unconventional thinking might just set you apart. If you found value in this video, be sure to hit that subscribe button and join me for more strategies aimed at beating the S&P 500. Let's keep climbing together.